Your thoughts on AMC, GameStop, and the effect it's having on these certain ETFs, once a small component, now for some of these funds, the largest component.
Yeah, you make a great point. I mean, we saw this in January and February. At one point, the XRT, which is the largest retail ETF, went from like a 1% holding in these stocks to almost a 20% holding. So it's distorting the passive universe. A lot of ETFs are supposed to be passive, but when you have market capitalization that grows quickly, the ETFs cannot recalibrate, and you have massive distortions. It's a great point.
Do you expect these ETFs, I mean, every quarter they rebound, so there's a chance that they take these stocks out. Do you think that could happen this time around?
Well, we saw some type of rebalancing with the XRT. I'm sure, I mean, if you're on the board of one of these passive ETFs, you have to make a move, because if you just look at AMC from the credit market versus the equity market, and this shows you the distortion, in 2019, okay, the bonds were trading at 96, so 96% of par, and the stock was $9, okay? Last week, the bonds were down at 80 cents on the dollar, 12% yield, 12% yield, okay? This is real junk, but the stock was 40 to 50 to 60. So it just shows you that if you're running one of these passive ETFs and you see that type of distortion where the credit markets are saying this is trouble and the equity markets are just, in speculative la-la land, then you got to do something.
Yeah, interesting. Right? I mean, last week the stock was up 100% despite a number of stock sales. There was that to moderate capital, then the 11.5 million shares sold to the public market for $587 million. Yet the stock continued to run up. Why do you think that is? And actually, I mean, do you think some of the money, the expectation actually is that some of the money they raised through these stock sales will be used to bring down its debt? So that should improve its credit position too, I imagine.
Yeah, it's weird. My whole career, the credit markets have always led equities. In other words, when credit markets are saying one thing, that's typically a phenomenal leading indicator. But in recent years, when the Fed is not allowing the business cycle to function over longer and longer periods of time, what happens is the cleansing process of the business cycle and credit markets gets somewhat eliminated. And normally, the cleansing process would correct, bad companies and take out the bad ones, and the strong survive. But when you don't allow the business cycle to function over longer periods of time, and that's what we've been doing the last 3-4 years, then you're exactly right. Then all of a sudden, a company that should have gone bankrupt can raise capital, keep raising capital, and the credit environment actually improves.
Right. And, to CEO Adam Aron's credit, he's been able to ride this sort of momentum and the intense investor enthusiasm around the stock. Yet, even with all of that, Wall Street analysts remain cautious. Wedbush Securities on Friday saying $10, that's their price target. AMC currently trading at $48 a share. I'm wondering, given how closely you follow the bond market, where do you think this stock should trade at?
Well, we saw this in January, February, where credit markets are saying one thing, and these stocks were way up in the heavens. And then they had a 70% drawdown. So for investors watching us right now, the credit markets were right in January and February. They were telling you that there was a big drawdown coming, and then we had a 70% drawdown. Now we're back up. So if I'm a younger investor listen, if you want to speculate and ride the wave, that's fine. Have a stop loss and just make sure you take half of your gains off the table. That reduces your downside. And you really shouldn't be in these plays because it's extremely speculative. You can get wiped out overnight. But if you have to, just make sure you're managing risk the best you can.
Understood. Quick word on broader markets, Larry. Correlation between these meme stocks and what it means for the broader averages?
Well, what's weird is since, the last 6 months, we've had the SoftBank whale blew up. Then Archegos blew up. Then the Robinhood crowd, this blew up in February. And so we've had these deleveraging incidents that have then transformed the market into a real deleveraging. I mean, ARK ETF, the ARK stocks were down 40, 50%, Tesla. So there's been like a stealth deleveraging going on. And now this meme environment is actually bringing some of that leverage back out of the system, whereas it's been coming, back into the system. It's been coming out for like the last 2-3 months. So I don't think it's sustainable. We're at a very strange part of the year where, sell in May, go away. Now we're into June. So, I just be very cautious. Once again, commodities, I think will outperform because with this new tax deal globally, you're going to just see a move into value names and commodities. So be overweight commodity equities and kind of reduce exposure to the speculative side.
Shepard Smith here. Thanks for watching CNBC on YouTube.